Hello and welcome to Bazaar Morning Call, live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me my colleagues Sonia and Nigel. Guys, hi. Morning.
Morning.
We just through one day yesterday. It almost feels like we've been through the week, right?
And it's the last day before the budget, right?
Absolutely.
I don't know about you guys, but I mean, despite covering the budget for over a decade now, every single time, you know, there's this adrenaline rush, there are goosebumps, you don't know what to expect. It's the biggest day of the financial calendar. So, yeah, I mean, it's pumping this time, I guess.
Well, that's right, Sonia. I think it'll only pick up from today because in the last few days, the markets have been, the attention has been deviated to a couple of other issues, whether it's with regard to the Adani Group or what the Fed's going to do. So let's see what the finance minister comes up with.
And apparently it's going to be a long speech. It's going to be a long budget.
It was pretty long last time. I don't know. Is it going to be longer this time?
I don't know. That's the buzz. Anyway, let's quickly get the ball rolling and tell you what to kind of watch out for. Now, global cues, which have been doing very well and have been very supportive, we've seen a bit of pullback there yesterday. I mean, that's the NASDAQ for you, down about 2% or so. The Dow pulled back, the S&P 500 was down a little lesser, but the NASDAQ is where the bulk of the pressure came from. It's not exactly bad, and I'll tell you why, because, the Fed has explicitly said that markets rallying is loosening of financial conditions which they don't want. And markets and financial conditions have been very, very loose for some time now, all through 2023 in the US with what the market has done. You want the market to go in with some humbleness, some humility into the Fed and perhaps come out unscathed on the other side of the Fed meeting. But I'll come to that a little later. So global cues, not all that supportive this morning. I mean, that's point number one. We saw a late recovery in the Nifty yesterday, and that kind of gives us another chance that 17,550 level could be defended. It broke intraday, but we closed above it by about 100 points or so. The 200 sort of exponential moving average is around the 17,550 mark. And there is also an important retracement, which we've been highlighting. The 61.8% retracement of the entire rise from the September lows to the all-time high. So there is a cluster of supports. Let's hope that this is defended. If not, the two other levels which come into play is yesterday's low, which is 17,405. And post that, the retracement support comes in at the next retracement support, which is 78.6 of that same rally, which is 17,205. As I said, let's hope, both yesterday's lows and 17,550, which is above that, those levels are held and we don't talk about further retracements. On the way up, as we've been saying, 17,761 is a bit of a resistance. It's not very far away. With the kind of moves we've had intraday, anything is possible. Now, the Adani FPO closes today. The Adani Enterprises FPO closes today. And I think that is, at least from a very near-term perspective, the key to investor confidence. Yesterday, we had an entity from the Middle East committing a large sum of money towards the FPO, but more needs to get done. And I think by today evening, post-market hours, we will get a sense of how this one is going. The reason I'm mentioning this is because it's, of course, important for that group of stocks. But what I'm focused on is banks. Because, banks have had an inordinate amount of fall over the last 3-4 days on the back of this particular issue. The bank Nifty, for example, is down 6.2% from the highs 3 days back to yesterday's close, not even yesterday's low. That would be some 7.5%. And of course, individual stocks as a consequence have pulled back quite a bit. SBI, for example, right? I mean, people would have bought it above 600 after the results, stocks down to whatever, 540, 550, and so many others which have come off very, very sharply. So, if the FPO gets subscribed, gets done, we can talk about what happens to those individual stocks, but I think banks should be relieved, and I think this is the pocket where perhaps one could look for opportunities from here out. So that's banks. In terms of levels on the Bank Nifty, the retracement support for the Bank Nifty stands at 39,970, and yesterday's low is 39,420. So those are levels which the market closed above after the pullback like the Nifty, and I think the Nifty Bank should hold those levels as well. We've got the union budget tomorrow. We've got the Fed decision later in the evening tomorrow. So these are big cues in that sense which are lined up. In a way, the to look at the silver lining, not a good thing, of course, but the silver lining, if you want to find one, is that the market is going into the budget in a very, very weak fashion. So expectations from the budget also are very low, and expectations from the market are also very low. And that is not exactly a bad setup if you're hoping that levels hold and maybe the market bounces back a little bit from here.
It reminds me of that discussion we had at Editors Roundtable, right? Where the conclusion was that from the markets and your marriage, you should always keep your expectations low.
Always.
So you will never be disappointed.
Key to a happy marriage.
All right. But, I mean, to take your point about banks, and I was just having this discussion with Gautam Dugar of Motilal Oswal just a while back, and we'll get that view in for you. A lot of people are now looking at the fall in banks as an attractive opportunity to buy. So SBI is down, for example, 15% in the month of January alone. So don't lose sight of that. But I think there is a lot of caution ahead of the budget, which may be a good or bad thing. Look at what the FIs did yesterday. This was the largest selling that we've seen in the last 7 months. So almost 7,000 crores went out in one shot in a single day. And this is the highest single day selling since June of 2022. So that, of course, draws a lot of caution back into the system. DI has bought about 5,500 crores in cash yesterday. Important to see if the Nifty holds on to yesterday's low, which was 17,400. So that's an immediate line in the sand on the downside. A couple of other things to watch. Of course, the handover from the US was on the weaker side. We get into the FOMC meeting as well. So that's another crucial trigger. But in our own cues, you have a lot of numbers that will be, that the market will be reacting to. Case in point, L&T, where the numbers look pretty good. So it was the outlook, the order book remains strong. In fact, the company said that they may exceed their ordering guidance if the current run rate continues, and will definitely meet their guidance of that 12 to 15% revenue run rate. So that's a stock to focus on, even as we head into the budget, which could be capex and manufacturing heavy. So keep an eye out on this piece. Autos come out with their numbers tomorrow. The auto sales for the month of January will be released tomorrow as well. We'll focus on names like Ashok Leyland, M&M, Maruti, TVS Motor, all expected to report good numbers this time around. So that's another focus area. Of course, the economic survey is at 12 p.m. today, and you have the union budget tomorrow. So the market could be in wait and watch mode. But these are a couple of pockets, right? Banks, after the recent fall, may look like attractive opportunities. You have capital goods names like L&T, and you have autos. So amidst all the chaos, maybe some pockets of value.
Well, that's right. Sonia, I wonder how the FIs are feeling. Yesterday they sold in cash market close to $800 million. And the F&O market as well was fairly bearish. And yet you had the markets ending higher. To run you through a couple of data points, institutions yesterday were net sellers. The FI net sell number was the highest that we've seen since middle of June. And yet the markets ended higher. How did that happen? Well, there was clearly a short covering bounce that did play out. The Nifty ended high with a gain of around 50 points. The open interest was lower by around 4 to around 4.5% odd. What did the FIs do in the F&O market? The short covering didn't come about because of them. They continued to pile on the short. So yesterday they added 8,000 short contracts on the long side. They unwound close to around 8,000 long contracts. That takes the short position to around 82%. We have seen in the past when they go very, very aggressive, maybe 85, 86%, that's what gives a bit of a cushion to the markets, because any spat of good news could trigger a bit of a short covering bounce. And that's the hope even this time around. On the option side, well, they bought 45,000 puts. So in case things go wrong, there is cushion on the downside. But what's heartening to see is yesterday, the calls that were written, they got unbound. And there were fresh puts that were written. Close to on 22,000 put contracts were written. And on closing bell, we made this point. Even though the markets were low, the 17,500 put, it appeared that it was getting written. The range yesterday was around 91 rupees all the way to around 150 rupees. So the writing that we're seeing at those levels gives you a sense that the 17,350 to 17,400 level, that could hold out in the near term. However, if you go to around the 17,800, 17,900 mark, you're expecting a bit of a resistance, which brings us to the levels. Yesterday's low becomes important. 17,400, just keep an eye out. The Nifty Bank as well, close to 39,500. If those levels break, then you're moving to around, that 200 DMA. But my guess is the way we bounced from yesterday, the markets are telling you, giving you a message that 17,400, 17,450, the bulls are coming into fight from there. Maybe a bit of a short covering bounce is due. Don't chase the opening, but at some point of time, you'll get a bit of a dip. And maybe if yesterday's low holds out, then you get a further bounce from here.
All right. So those are levels to watch out for, and in terms of a setup as to how to approach the market. Before we start, let me tell you what is lined up here in the first half hour of the show. We get you updates from markets across the globe. Caesar Massery of Goldman Sachs will join us to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At around 8:30 this morning, we do a fundamental stock check with Deepan Mehta of Elixir Equities. Stay with us.
Okay, so there's plenty coming through. In fact, we have two important market views as we kickstart trade this morning as well. On the equities front, first up, Gautam Dugar, as we were just discussing a while back, he told us that all eyes will, of course, be on the budget tomorrow and events surrounding the Adani Group. But he also said that PSU companies' earnings like BPCL, GAIL and Punjab National Bank are all below expectations, and the second half of the results season, which we watch closely. Gautam says that the downgrades are higher than upgrades in this results season. He also spoke about how banking stocks are now looking attractive after the recent fall, and he expects some relief for the middle class in the budget in order to boost consumption.
Well, on the equities, Sunil Thirumalai of UBS says that Nifty EPS momentum has been weak, with more than half the 50 stocks seeing cuts for FY23 and 24, while financials are seeing upgrades. Commodities, autos, Reliance earnings are the drags. From an emerging markets perspective, Sunil says India is offering subpar growth and ROEs for still premium valuations. Thus, despite the recent underperformance and low FII holding, they do not see foreign flows rushing into the market in a hurry. Their preferred sectors include banks, consumer staples, telecom and auto.
The currency has moved in a very narrow band in the last few days ahead of the budget. So let's get you some money market views as well. We closed at 81.50 on the rupee yesterday. Bhaskar Panda of HDFC Bank says this week is quite busy for the markets as the US Fed, the ECB and the Bank of England are likely to raise rates, followed by the US jobs report. Back home, the union budget announcement is also due this week. Yesterday, oil prices remained a little subdued while the dollar index rallied on the risk-off mode. Given this global context, Bhaskar Panda expects the dollar-INR pair to remain tense in the range of 81.50 to 81.70 to the dollar.
Well, on bonds, we've got Bhaskar Panda who says that yields closed higher ahead of the union budget and he doesn't foresee too much upside from here. He expects the 10-year benchmark yield to trade in the range of 7.4 to 7.45 for the day.
Well, there's a lot of stock-specific action to track for you, and we'll get to that in just a bit in our special Top 10 segment. We'll be looking at BPCL, IIFL Finance, Nippon Life, MRPL. They are stocks on the back of positive news flow. And today, we have more number of stocks we're expecting to open up in the red. L&T, Tech Mahindra, RDC, Aztec Life, Orient Electric, as well as Inox Leisure.
Okay, well, let's get you a global perspective straight off the bat. Caesar Massery is head of emerging market cross-asset strategy at Goldman Sachs. He's joining us right now on the program. Caesar, great to have you with us here. Appreciate your time here on CNBC TV18. Have markets kind of decided to move on in the US from the sort of inflation is the big worry and rate hikes are the big worry kind of narrative? Because we've had a decent rally to begin 2023, Caesar. What's your view?
Yes, I actually think that's a pretty fair characterization. Markets have moved on, not that there's still no challenges ahead, but they've moved on from, I think, tail risks, at least on the inflation front. Inflation is still high. It's coming down. It's still uncomfortably high. But I think the wage data we've received the past few months suggests we probably will not see a wage price spiral. So you've sort of eliminated that tail. And I think the market is probably a little bit more focused on growth risks going forward. The soft landing is our base case, but that's not exactly, I think, where all market participants are convinced just yet.
We also have a big event upon us, Caesar, the union budget, and there are several dimensions on which the market could rate this budget from an investment standpoint, whether it is, the transparent, incredible fiscal math, or even a continued, perhaps, capex thrust, some tweaks in the tax regime. As an investor and as an onlooker, what would top your list this time around from the union budget?
Yeah, I think we've discussed this over several years on the program, and my view is always you probably want to see some pro-growth expenditures or views in general. I do think, or I'd make two kind of separate points though. Number one is I think India has benefited from oil prices coming down a little bit in the past few months. So I'd be curious if there's any views in the budget as to where subsidies might need to go or what sort of assumptions of oil prices they might make. The Goldman Sachs view is, of course, quite bullish on oil. We think Brent can top $100 by the end of the year. So that's kind of one moving factor. But I think the second factor that I would just mention is, frankly, the global investors are really looking at the big picture themes in the world, which is, China reopening, dollar weakness, and whether we'll get a hard or soft landing in the U.S. Frankly, those really remain front and center across the investor landscape.
Hi, Cesar. Good morning. What about India? I think in the past you've mentioned that India was relatively more expensive, which is a fact in comparison to other emerging markets. The good news, though, is in the past 1 year, we haven't done much. So we've gone through a bit of a time-wise correction. What's your view on the Indian markets from here on, and how do we shape up versus our peers, maybe markets in Latin America in comparison to China?
Sure. Look, I think on a structural basis, as we've said, I think many times, India remains a core portion of our holding and our investment view. I think there's a very strong growth story that every viewer on this program is well aware of, so we don't need to repeat. I just think tactically, there are a couple things going on. Number one is rotation. Again, the big dynamic that has shifted in global markets is we've moved from a period of a very strong and increasingly strong dollar to one that's weakening or softening somewhat. And that tends to favor other parts of the emerging market complex, whether it's in North Asia or in Latin America, for example. And secondly, you're dealing with a bit of risk on in equities. India has been fairly defensive. You're talking about rotation. India was up last year, right, in a year where most EMs were down, where the S&P was down about 20%. So I think there's just some tactical opportunities elsewhere.
So is this, Cesar, just to come back, right? I mean, if there is a, not a reflation trade, but if some of that comes back, right, is it going to be broadly a good year for equities then, Cesar? I mean, money goes into equities, emerging market equities, developed market equities, yeah.
Yeah, so in general, again, what we've found in our research is that flows, particularly into the equity market, is not zero sum. Right? And so when investors are looking to add money towards DM equities, they're also adding money to EM equities as well. So I would agree with this idea of if we have a bit of reflation, meaning growth data is better than expected, and keep in mind the consensus view is still for basically a recession in the US. So if we sort of beat that expectation, yeah, I do suspect we'll see added allocations to equity investments broadly. But I would also say, and I think India is a great example of this, flows don't drive everything. I mean, as you well know, we had foreign outflows from India last year, yet the market was up, and that's because there's a very robust domestic institutional investor base. So hopefully we have to care a little bit less about these flows going forward and focus more on fundamentals, I would say.
So you did mention that India remains a core portfolio investment for Goldman Sachs at the moment. What is the best way to approach the Indian markets now? Should you wait and watch? Should you start to deploy some money now? If yes, which are the pockets that you like? Because financials have seen a big fall this month due to an exposure that a lot of these banks have to the Adani Group, and I'm sure you've heard of all the details there. But is it a good time to be adding some money here?
Yes, I think that's probably a fair assessment. Again, our focus in EM right now is primarily in North Asia. Again, I think if we speak just tactically, meaning the next few weeks or even perhaps the next couple of months, the big story is still on China reopening, which I think you can manifest by direct investing there, or perhaps in Korea, which is our top EM. Again, tactically, you mentioned a bit on the sectors in India. Look, I have been pretty optimistic on financials broadly. I understand there's some micro issues that are quite idiosyncratic. We've seen them in other markets in the past, and I think it's hard to make a macro case based on, again, a micro idiosyncratic situation. But I am a little bit more optimistic on the banks. And the thesis there is that we've probably seen a peak in nominal rates if you look at the 5-year tenor. And typically in most emerging markets, when you've reached that peak in nominal yields, the financial sector tends to outperform subsequently. So yes, I would start to add positions in that sector.
Okay. Just one last question from my end, Cesar. The government has continued to champion, fiscal consolidation over the past couple of years, despite all the challenges that we've seen globally. If that does continue this time around as well, and we'll hear about it in about 24 hours from now, the fact that India has managed to contain inflation and the external deficits, does this macro stability in India add to its premium, when you compare it to a lot of peers globally? I mean, you briefly mentioned that Korea is your top market to invest into, but does India also rate high in your pecking order?
So again,
because of the reasons that I mentioned.
Yes. So if we consider a medium to long-term view, call that a 1-year plus view, the reason you mentioned in terms of fiscal consolidation, or I should say fiscal prudence, is absolutely paramount, and we would generally want to see some fiscal restraint. If you look at other EMs, again, whether it's South Africa or markets in Latin America, they command a much smaller or lower valuation, I think in part because of fiscal deficits that are a bit wider. So that is definitely a structural story, that I think is quite strong for India if we see a little bit more fiscal restraint. However, again, I just think what markets are focused on in the next few months is really who's going to benefit from a weaker dollar and some of the better growth tailwinds coming out of China. That really is the focus for the first quarter of this year.
Okay, all right, Caesar, thanks so much for stopping by. Wishing you a good day and, in fact, a good year ahead as well. Look forward to chatting up with you rather soon. For the time being, though, we'll slip into a short break. You come back, we'll tell you all the top stocks that you need to track for today's action. Don't go anywhere.
Okay, it's interesting times for our market. 1 day to go and we have the big union budget upon us. There's the US FOMC meeting. We've actually lost count of the number of triggers that this market has, and we're just taking it 1 hour at a time. But L&T is the stock in focus this morning after a good set of numbers that it reported. Vivek is here to give us the fine print in case you missed out on it overnight. In fact, our entire research team is joining in. Hi, folks. Morning. Vivek, let me come across to you. How did L&T look?
Well, good morning. A mixed quarter as far as L&T is concerned. Very strong order inflows, very strong order inflow guidance. But the marginal risk was as far as, the EPC margins was concerned. And, which is why we're going with the marginal red as far as L&T is concerned. Now, however, the management commentary, especially in the conference call, was extremely positive. They said that, in the first 9 months of FY23, the order inflow has been much stronger than what they were anticipating. And in fact, they've actually said that they will most likely meet the upper end of the guided order inflow band. Analysts believe that they may be able to exceed it as well. Now, looking at the numbers itself, revenue is up 17.5%, largely in line with our estimates. So the EBITDA margin, softened a little bit, and that's the key disappointment. 10.9% is where it came this time around, and profitability, on back of the lower margins came in, slightly below the estimates as well. Two key takeaways, the company has said that likely to beat and achieve the higher end of the 12 to 15% order inflow, as well as the execution guidance for FY23. However, the company's core margin guidance has been cut from 9.5 to 8.9%, and that's the only disappointment from L&T this time around.
Okay, all right. Thanks a lot for that, Vivek. Well, let's hop across to Sonal. Sonal, BPCL's numbers look good.
Yes, they did actually. It was a top-down beat led by their refining segment. If we talk about the basic numbers, revenue growth of 4% to come in at 1.19 lakh crore rupees. EBITDA came in higher on a quarter-on-quarter basis at 4,200 crore rupees. The expectation was of around 3,800 crore rupees, so that's a 400 crore rupee beat. EBITDA margins at 3.6% versus 1.3%. The poll was at 3%, so that's a 60 basis points beat. Net profit also higher at 1,959 crore rupees versus an estimate of 1,436 crore rupees. The reported GRMs this time around came in at $15.5 per barrel versus an estimate of $15 per barrel. Not only that, even the marketing volumes came in higher at 12% growth on a sequential basis versus an expectation of 8% growth. Margins on petrol now are at 10 rupees per litre, while on diesel it is a loss of 6 rupees per litre. So on the back of that, Jeffrey says that now going ahead for all the oil marketing companies, the big trigger is the upcoming budget, because it should give more clarity on government support to the OMCs, because the prices of both petrol and diesel have been frozen. So that is the next thing that we'll be watching out for. But today for BPCL, it's a green.
Right, thanks very much, Sonal, for that. Now, Tech Mahindra reported numbers after market hours yesterday. Rima is here with more. Rima, hi, morning.
Hi, morning. So it's a mixed quarter for Tech Mahindra. Revenue is muted, but margin expansion is more than what the street was anticipating. So on the top line, the company has reported a revenue growth of 0.2% in constant currency terms on a quarter-on-quarter basis. This is lower than our estimate of 0.5% and weaker than what peers have reported. The company said the impact of furloughs was about 1%. Some of the furlough impact will spill over into Q4 as well. And CLSA is saying that they're estimating a flat quarter for Tech Mahindra in Q4. Weakness was seen in manufacturing and the BFSI vertical. But as I said, the margin performance was better than what the street was anticipating. Margins expanded by 60 basis points to 12%, ahead of street expectations, and deal wins too at $795 million is an improvement of 12% on a quarter-on-quarter basis. So weak top line, good margins and good deal wins. Back to you.
Okay, all right. Thanks a lot for that, Rima. Let's hop across to Abhishek. He's tracking a few more numbers. Abhishek?
Well, to begin with REC, it's a weak set of numbers coming in from there. The net interest margin and spreads are at 19-quarter low of about 3.55% and 2.75% respectively. The gross NPA ratio, that is at 5 years low at about 3.63%, and net NPA ratio is at 7-year low of about 1.24%. They had strong disbursals momentum, up about 150.3% YOY and about 66.25% on a sequential basis, but this has not translated into AUM growth. That remains weak and in single digit both YOY and quarter on quarter. The net interest income is down 12.5% YOY and about 11% sequentially. Operating profits, they continue to decline on a YOY basis for second quarter in a row. Lower provision, or let's say provision right back this time around, aided the PAT growth both YOY and quarter on quarter. IFL Finance, now a secured product like gold finance, is seeing a disbursal to AUM ratio of just 6.3%, which is astonishing, or actually a weak point in the results. Overall, its disbursals to AUM growth is just to 20%, which is on the lower side for secure product and long-term products. So disbursals are up 22.5% YOY and about 8% sequentially. The AUM growth is about 24% YOY and about 4.8% sequentially. Asset quality has improved. Both the gross NPA and the net NPA ratios have improved. The NI is up 33.8% YOY and about 8.8% sequentially. Calculation shows that the net interest margin has expanded both YOY and quarter on quarter. So the net profits, that is on a consolidated basis, is up about 32.7% YOY and about 0.7% sequentially. Back to you.
Got that. Thanks a lot, Abhishek. Well, there are a bunch of other numbers that have come through. Nippon India AMC, Aztec Life Sciences. Surbi is tracking all of that for us. Surbi, over to you.
Hi, thanks for that. To start with Nippon Life, the company has reported a good set of numbers. Revenue and profitability both were above expectations. Revenue was up 7% sequentially at 354 crores. Their core operating profit, that was up 10%. Their quarterly average AUM was up 4%. This was due to higher flows in the B30 markets. The yields were better than expectations at 48 basis points versus 46.5 basis points in the previous quarter. Moving on to Aztec Life, the company posted a poor set of numbers. It was a top-down miss. The revenue was down 32% on a year-on-year basis at 117 crores. Their EBITDA was down 72%. Their margins have more than halved at 10% versus 25% same time last year. And the PAT is down 97% at 84 lakhs.
All right, thanks very much for that. Well, back to Sonal with more earnings like MRPL, Orient Electric, Inox in focus. Sonal, hi.
Good morning. Well, let me start with MRPL. Good set of numbers. If we talk about the revenues, they're up 8% on a quarter-on-quarter basis. The company has reported an EBITDA this time of around 290 crore rupees. However, they still have made a loss, but the losses have contracted. So losses at 187 crores versus a loss of 1,800 crores on a quarter-on-quarter basis. GRMs at $3.88 per barrel versus negative GRMs in the quarter gone by. Orient Electric now, weak set of numbers. Revenues were up 9%, but EBITDA down in 18%. Margins also declined by 200 basis points. Profits were down 13% as well. In their segmental revenues, both of them did well in terms of revenues, but it's the margin miss which leads to the red tick on the stock today. Inox Leisure, again, it was a margin miss. So while revenues were up 74%, EBITDA was up 31%. Margins declined to 33% versus 44%, and it was a net loss of 40 crores versus loss of 1.3 crore rupees, also because of a lot of one-offs as well. They had the highest average ticket price of 230 rupees and highest spends per head at 106 rupees.
Okay, thanks a lot for that, Sonal. Thanks to our entire team, actually, for giving us all the updates so early this morning. Here's a quick recap of our top stocks in case you missed out on them. Positive news flow coming through from BPCL, IIFL Finance, Nippon Life and MRPL, while stocks with negative news flow, L&T Tech Mahindra, Aztec Life Sciences, Orient Electric and Inox Leisure. But let's also get you a quick update on what's happening in the world of commodities. Remember, there's a global rate hike looming especially from the US as the FOMC meeting begins. Manisha Gupta is joining in. Manisha, gold, rather Brent, has been hovering around $85, $86 a barrel. How's the mood going into the FOMC?
Oh, well, slightly on the choppy side, clearly, Sonia, as you mentioned, it's going to be a very data-heavy week. You have the US Fed meeting, and then you also have a follow-up from European Central Bank and the Bank of England. Those meetings are also slated in this week itself. And key economic indicators from China and European Union are also on tap this week. So the moves are subdued ahead of the policy meetings from all of these banks. There is some profit-taking as well as the US dollar index has gained. So you have the Brent prices now down 2% in this week already ahead of the US Fed meeting. Overall, the energy pack has been slightly on the declining side. So the coal price is trading at a 6-month lows now, below $300 a ton. You have the U.S. gas prices trading at the lowest since April 2021. And we have seen the prices for gas in U.S. decline by nearly 30% in the first month of 2023. You mentioned about gold, and yes, that is also on a declining spree. We have seen a high of $1,950 an ounce in the previous week, just about holding $1,920 or $1,925 right now. Even the silver prices have come off at 7-month highs. Copper is now off at 7-month highs as well. So the very strong start that we saw in the last 15, 20 days in the month of January, some profit taking now seems to be hitting the street.
Okay, profit taking hitting the street, Manisha. Thank you very much. We'll come back for more later. We'll take a quick commercial break here. We'll come back. Deepan Mehta of Elixir Equities will join us for some fundamental stock analysis later. We'll have the management of CSB Bank, Pralay Mondal, to talk about the third quarter earnings, which they reported. Stay with us.
Welcome back, folks. Let's drill it down straight to individual stocks. You just heard from our team about all the top stocks to focus on. Deepan Mehta, director at Elixir Equities, is joining in now. Deepan, good morning. It's the big budget tomorrow. How many budgets have you seen up until now?
Good morning, Sonia. I've been tracking budgets since the age of 11, so I mean more than 40 budgets I must have seen.
Okay, so you'll be best placed to tell us. You'll be best placed to tell us, Deepan, whether the budget affects the market or not. Be honest.
It doesn't affect. Earlier, the budgets used to affect a lot because there are a lot of indirect taxes and a lot of surprises would be there in the fine print. But this time around, I think the budgets are a bit of a non-event. It's just a statement of planned expenditure and the focus areas of the government, and then those stocks start to rally a little bit, but that rally also lasts only for a few weeks or so. And one doesn't really remember what happened in the budget. I mean, if you ask me today what was the highlight of the last budget, I'll be struggling to find the facts over here. But nonetheless, I think, it creates a feel-good factor, and it brings about a lot of checks on what the government is planning, which are the sectors they want to give encouragement to. And on the whole, I think if even minor thinking is done with the personal taxation, some relaxation, then I think it'll be very well received by the market. And of course, we pray that there is no change in the capital gains tax structure for stocks. Otherwise, that would be a big, big sentiment dampener.
Well, hi, Deepan. Good morning. Deepan, a couple of these names have got hit, the Adani Group stocks, Adani Ports, Ambuja Cements, as well as ACC. Some of them, valuation-wise, well, they've come to more reasonable levels. Any view on any of these three?
Good morning, Nigel. No, I think it's best to stay away when there's so much of controversy surrounding a stock and every day it is in the news. In such situations in the past, I have seen it's best to stay away. I think let the entire situation cool down and see what the final outcome is, and then perhaps take a call. It's not that these businesses are one of a kind and you have to own them. Otherwise, you will miss out on a major upside. You can always buy similar businesses which are trading at equal or lower multiples, and that should be just fine. So I like to avoid all these stocks which are in the focus just now. And there are many companies which have come out with excellent set of numbers this earnings season. New investment ideas are opening up, and I think one could focus over there. And even some of the laggards, I think they came out with very good set of numbers like Bajaj Finance or even L&T for that matter.
Deepan, hi, good morning. The other area which has seen some amount of, of course, one has to qualify when I say indiscriminate selling, depends on whether you like the space or not, is banks. Has taken a real knock. Bank Nifty is down some 6% in 3 sessions. Is this area where you will look for some opportunities? Are you already finding those?
Yeah, Prashant, I think that if you're underweight banks in your portfolio, this is a great opportunity to get equal or overweight. Although we have seen a correction going into the future, next 2, 3 years, even longer, I think banks will be back in leadership position. They are in a secular growth momentum at this point of time. And till the next NPA cycle comes, I think it's kind of a blue sky scenario for the bank stocks. But I think looking at the way the numbers have come through, my personal preference is again moving back into the private sector banks. The tier two banks like say IDFC First Bank, IndusInd Bank, Federal Bank, I think they came out with a set of numbers which were better than street expectations and to an extent equal to or better than the larger banks as well. So you could have a sense of outperformance in the tier two private sector banks. PSU banks remain as a bit of a trading rally, of course. But one can never be sure that where these companies would report 2, 3 quarters down the line. We saw what happened in PNB today, or rather yesterday, where unusually there was a large NPA provision which was required to be made. So, tracking the PSU banks and having a handle on their earnings is very difficult. So, from that point of view, I prefer private sector banks. And I gave the names just now. I think those are all done exceptionally well. And next 3, 4 quarters, you could see decent outperformance coming in from that segment within the banking space.
Did you say CSB Bank was one of the banks that you liked?
No, I said IDFC First Bank, IndusInd
IDFC.
Bank, Federal Bank. I think those all came with very good set of numbers.
Okay, I thought I heard CSB Bank, but you know what? I mean, I would request you to stay on because we do have the management of CSB Bank with us. And this time around, what stood out in their performance is the gold loan book. The growth was very strong over there. A 50% growth year on year is what they saw in their gold loan book. And, that overall picked up their performance. The operational performance was pretty good as well. So let's get Pranay Mondal, who is the MD and CEO at CSB Bank, who joins us now. Mr. Mondal, thanks a lot for joining in. Gold financing has been leading your business momentum. As I said, a 50% growth in your loan book. Can you tell us overall, as a percentage of your book, how much do you plan to grow gold by? And what will the loan growth look by the end of the year and in FY24?
Thank you, Sonia, for having me, and a very good morning to your viewers. Yes, we had a very, very good growth in the gold loan portfolio. We grew almost by 51%. Even better is the tonnage grew, so it is not related to gold price. Our tonnage grew by 49% with 37% on customer acquisition. So I think it has been a good franchise which we're building. I think it should not go beyond 50% of our portfolio the way it looks like. And as I've said before, that in our longer term vision by FY 2030, gold should be around 20% of our portfolio, retail should be around 30%, and rest will be divided between SME and wholesale. But in the short run, gold will become a very important portfolio for us because the credit costs are very low, almost close to zero. You have operating cost, which is already baked in, and it has very high margins. So from that perspective, since our branches and every other infrastructure distribution processes are in place, we are serving the system to get better businesses from gold loans and hence invest into technology and other franchise, which will become the growth engine for the next 7-8 years.
Okay, all right. Mr. Mondal, we take that view on board, and you have really ramped up this gold portfolio, which is very, very encouraging. My question to you is, for the bank on the whole, what is the loan growth you're talking about? I think you were mentioning for the next few years, you all will see around 20% growth before you see a hockey stick growth. I think that's post 2027 onwards. So give us the loan growth that you're looking at. And given that gold is 47% of your portfolio now, the yields out there are better, more than 11%. So what is the outlook on the NIMs then, which were at around 5.8%? Go ahead, sir.
Good morning, Nigel. Yes, you're right. Gold is around 47%, but as I said, that in the long run, gold will be around 20% by FY 2030. On the growth for the bank, broadly, we had said last year we grew by 9%. So I said that that was slower than the system. So this year we will demonstrate that we'll grow faster than the system, which we have so far done. And we hope that we'll continue that momentum this quarter as well, and hence for the whole year. I had already told before, which I'm repeating, that on a 3-year CAGR basis, we will be roughly 50% of the system, faster than the system, which means that the system grows at 15 to 16%. And on a 3-year CAGR, we will definitely grow anywhere between 22 to 25%. I think we are in the higher end of that curve right now. And as the base grows, we will have other businesses also kicking in. We are putting a lot of effort on retail, payments, SME, wholesale, and all those businesses, transaction banking. So all of that will start giving us the growth. On the margins, yes, 5.8% was last quarter margin. That's not sustainable because the cost of fund is, as you know, that deposit costs are going up, so cost of funding is going to increase. Yields sort of peaked out. So to that extent, as I said before, we will be happy with a 5% margin in the long run, provided we are able to continue the growth momentum.
Okay, 5% net interest margins. Pralay, hi, good morning. Gold loans, I think the market waits to hear from you on gold loans because not just how it impacts CSB, but other banks as well, other gold finance companies as well. Some, of course, who are geographically close to you, right, where you're located and do bulk of the business, which is down south, Kerala. But how is the big concern really has been competitive intensity. I'll tell you, here in Mumbai, where I live, State Bank of India opened a big branch close to where my residence is. And, there's a big banner right up front. And the only thing on it is, personal gold loans. A full big flyer. So, so competition is something we are hearing is very intense in the space. So just wanted your quick thoughts on that. How's that panning out?
Prashant, I've been in banking for decades now. I'm trying to figure out which segment doesn't have competition. But gold loan, let me put it this way, that it's also requires a core competency to build that business. There is a lot of operational processes, efficiencies, understanding, learning, like any other business has. This business also has. So overnight, building or scaling businesses are not easy. Having said that, I'm just wondering when we will discuss anything other than gold loan when we discuss about CSB Bank.
But that we'll do.
Mr. Mondal,
we'll do that when there is. I think the aim is to do that. We'll as the share of gold loan comes off from 50% gradually 45. I think we'll allocate questions in proportion.
But Mr. Mondal, you don't want to discuss the weaker parts of your portfolio, right? Or do you? Because that was my question. That was the next part of my question, where SME and corporate has not been growing at such a fast pace. And why is that? I mean, corporate is in low single digit. SME is actually fallen this time in terms of loan growth. Are you seeing pressure over there, and what are you doing to address it?
So let me just tell you what I said last time, because banking, quarter to quarter, the strategy doesn't change. For the next 3 years, our quarter strategy will not change. So the fundamental strategy is invest into newer businesses and invest heavy, because we are majorly investing into technology and distribution and leadership. And that will only happen because we have to give quarter-wise cost to income, other ROE, ROAs, everything. And ROA, we are 2.37 this quarter. So we have to deliver those while we build the franchise. So here it is, we are trying to transition an engine when the engine is running. So to that extent, we have to continue to do well in gold loan to invest into the future. On the SME and wholesale, yes, we are very, very focused. The transaction banking portfolio we are trying to build. We are putting a lot of systems and processes in place. Retail assets, we have launched a lot of products, and we will see a lot more. And we are changing our core system. We are changing our entire ecosystem on the technology side. So retail and SME is a slightly highway, which takes time to build. Also, the risk-adjusted return in SME at this point of time is not as per our risk appetite. So we are very, very careful in terms of what kind of businesses we choose. Be rest assured that our long-term strategy is very clear of 20, 30, 20 and 30. So that's the way we will continue to build the portfolio.
All right, Mr. Mondal, very quickly before we let you go, we've got the NIMs clearly. 5% is what you're looking at maintaining. Loan growth, you're looking at outbeating the industry. Could you give us a number? What should you end FY23 with? What should you end FY24 with? And before we let you go, asset quality as well. Briefly, if you could tell us on the gross and the net NPAs.
So on the growth, as I said, that you're seeing around 24 to 26% growth for us.
Okay.
I think the momentum should remain there. On the asset quality, yes, NIM, I said 5.8. It may not come down to 5 quickly, but I'm saying that I don't mind 5 provided I continue to growth momentum. And on the asset quality, as you saw, that our net NP has come down to 42 basis points. Gross come down significantly. So 1.37, I think, and net credit cost is still negative for us. That's too good to a story to be true forever, but we'll take it as it comes. Next year also, I think, continue to have a good portfolio. We don't see any concern on our portfolio next year as well.
Okay.
Okay, we will leave it at that. Thanks a lot for joining in, Mr. Mundal, and have a great 2023. Of course, you have the big budget tomorrow, so very interested to hear your opinion post that as well. We'll try and touch base with you later. Dipan, a quick comment on CSB. They've spoken about how over a 3-year compounded growth period, they're looking at a 20 to 25% growth, which is pretty robust. Is this a bank that you would add to your list? If you map the last 3 years of the stock performance, the stock has done nothing for investors. Do you think fortunes would turn?
So I think the issue with CSB Bank is geographical concentration and product concentration. And it's a pretty well-managed bank, available at reasonable valuations, but I think that's true for many other banks. And our preference is for some of the larger banks where growth rates are similar, valuations are similar, but their product diversification and the geographical diversification provides a little bit more comfort. So I would just like to wait and watch as far as CSP is concerned. And as I said, I think there are better ideas in the banking sector. Even the larger banks have performed as well in terms of top line, bottom line growth as CSB has in the last 3-4 years. And they are far more safer from that point of view. So I would just look at some of the other banking stocks rather than CSB at this point of time.
All right. Deepan, we'll take a quick commercial break. Stay with us. And when we come back, we'll have...
Welcome back. Hope you're having a good morning. For starters, the SGX Nifty suggesting a bit of a green tick, actually quite a bit of a green tick. It's suggesting that we're likely to open up in the green with a gain of close to around 80 points odd. But I think we have our technical experts who are standing by. So Sudarshan as well as Mitesh join us. Good morning, gentlemen. Thanks so much for joining in. Well, Sudarshan, let's go across to you first. What's your call on the Nifty?
Good morning, Nigel. See, yesterday the idea was that 17,400 should provide support, and if that support holds, then we should consider start buying. That luckily went very well. Now, I would think that that support is likely to hold for some more days, but remember, there is a very big event in the shape of the budget coming tomorrow, and there's no way I can predict what the markets will do after the budget. So, assuming that nothing changes in the budget, 17,400 should hold, and we should be looking to buy today also, and if nothing changes, then tomorrow also.
Okay. Well, all right. I mean, it is a tricky time, right? Mitesh, what would you do in a market like this? We're going into the budget quite weak. There's large FI selling as well. Is it a no trade zone today and tomorrow, or are you looking at some strategy for the day?
So, not a no trade zone very clearly. I think, the markets do provide opportunities. But on the index, I would want to go long only once we see stability above 17,800. That was the key support pivot when the markets were consolidating in late December and early January. And I think, till that gets taken out on the upside, I would be skeptical of any move towards it and, possibly treat that as a pullback. Only if we start getting strength above 17,800, then I think we'll have a stronger reversal, which could give you about 400, 450 point kind of a trading rally. So that's the approach on the markets. But for the time being, trading with stock-specific biases clearly.
Gentlemen, good morning. Mitesh, in terms of specific stock trades, what would you have?
So, Prashant, I have a mix of buys and sells. There's more bias towards the long side today because the IT sector is doing very well. A lot of stocks are reversing. So I have 2 IT names on the buy list. Emphasis is the first stock. That's a buy. Keep a stop at 2095 or just below it, and a target of 2160-65 could be looked at to begin with. Similarly, Coforge, post the numbers, has been clearly in an uptrend. Last 3-4 days worth of consolidation now looks set to restart the up move. That's a buy with a stop at 4390 for a first target of 4475. And the third buy is Tata Motors with a stop at 435. I would recommend a buy for a short-term trading target of around 460 on the upside. One sell call on mild pullbacks. JSW Steel can be shorted around 7.8, 7.10 with a stop at 7.22 for a target of around 6.85.
Right. Sudarshan, how about you? What would your stock ideas be for the day?
Well, I'm looking at mid-caps that have been outperforming, and given my view that this market could slowly inch up, they are buying opportunities. So Dr. Reddy is a buy with a stop under 42.50. TVS Motors is a buying opportunity. You know, it actually went up for 2 days even when the Nifty was falling. Yesterday it had a down day. That's a buy on dip. So buy with a stop under 1015. Syngene is my only short trade. Short selling should be done only intraday. Consider going short with a stop above 577. And Coal India is another buying opportunity. A large base is being built. Now it will break out when it will. But even for the short term, it's a buy with stop under 220.
All right, thanks a lot for that. Well, Anuj is also joining in now for a quick trade setup. Anuj, morning. The good part is that the market is going into the budget with zero expectations. It's going in weak. But what are you looking at in terms of trade?
Yes, Sonia, morning. Look, I mean, the issue is, as you said, the market's quite weak. But I don't know if this is just pre-budget nervousness or something more. Because if it was just pre-budget nervousness, you know, I would have said that, okay, things are looking quite good from here on. I mean, if you look at the Nifty, I think picture speaks 1,000 words. If you look at the two pictures, both for the Nifty and the Bank Nifty, it's beautifully set up. The lower lows and lower highs. And one thing which is interesting is if you see the highs on the Nifty, 18,200, 100, and 17,884, and 17,709. And low is 18,078, 17,846, 17,493, and 17,405. On the Bank Nifty, what was interesting is that, again, you're making lower highs and lower lows, but for the last couple of days, even the high was lower than previous day's low, except yesterday when things changed a bit. Also, we had a last hour rally on the Bank Nifty, but still, the market has been making lower highs and lower lows. So for me, the bottom line is that you need to break this cycle. How do you do that? I mean, let's see. If you look at global market, there's a very interesting chart. I mean, if you look at the Nasdaq chart, it's at a crucial make or break level. It's at, you know, almost negating a double top. And same as the chart with Indian IT, because if that happens, then you are looking at another 10% rally. But if that double top gets confirmed, then there could be a problem. And I think on that, the issue to watch out for would be the rate hike by the Fed. If it's 25 or 50, my sense is if it's 25, there could be a big rally. If it's 50, there could be a big decline. It's almost a binary event lined up ahead for us. And the other thing is what's happening with the Chinese PMI, which is quite strong. So that theme is still intact, which is telling you why the money is moving out from India and moving into China and the other East Asian market. That theme is still to play out fully. On the Nifty, the levels I'm watching out for are the 200-day exponential and simple moving average. Nifty is holding them on close and intraday basis. Those levels are 17,600 and 17,300. Let's see if we make a higher high or not, or higher low. On the Bank Nifty, the last hour rally actually was quite strong. And the fact that it was led by ICICI Bank and SBI would soothe some nerves. But again, we need to see post-budget whether, because of this positioning, the market can see some rally. And of course, there's this small issue of Adani FPU, whether, you know, that sails through or not, because that will have an impact on the sentiment as well.
It's a small issue. Like that, like how you put it. All right, slipped it in there, right? All right, thanks very much, Anuj, for that. We'll take a quick break here. We'll come back. We've got, what,